Well, ladies and gentlemen, on Rethink Real Estate, we have Kevin Guttman. Now, Kevin is a specialist when it comes to reverse mortgages. I wanted Kevin on because it was a timely topic, because I was asked the question about somebody going through retirement and some different creative things that they could do in order to release some of the equity in their home whilst not selling it. And I just immediately thought of a HELOC, but then I don't like my own HELOC because it creates debt service, and you don't want debt service. Obviously, reverse mortgages, you might be rolling your eyes going, Ben, how did you not know this? But it actually really provoked a few little things for me, is that going through this with him, I'm thinking like, hey, this could be ultimately going through your database and actually creating deals for yourself. It could be very, very helpful in that way. But again, really interesting to go through this in detail to find out another option that you can provide your clients. Hopefully it helps. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Kevin, welcome to Rethink Real Estate.
Hey, thanks for having me, Ben.
Now, we're here to talk about reverse mortgages today. Well, we're probably more so the retirement element of people's chapter of life or season of life. I really do. I was when I had the opportunity to have you on the podcast, it came at a pretty ideal time. I was speaking to a realtor, and they were asking me questions about, my sellers, they want to retire, they want to, make sure they're going to be moving to another part of the country from California to another part of the country from an affordability perspective. And they asked me if I knew anything that could help them or whatever it is. And I have to be honest, I really didn't, because they wanted to purchase before they sold their home out in California. They wanted to, do all of these different things that in the idealistic world. And when I hear the words reverse mortgage, and this is where I want you to correct me if I'm wrong, I think about a line of credit, right, on a home. And like, I have a line of credit on my home. I very rarely use it. And the reason I don't use it is because it creates debt service for me. And I'm not interested in just paying interest on a line of credit, because it just goes into oblivion. So give me an understanding of what are the misconceptions of a reverse mortgage. Maybe we start off at what is it? Give us a bit of a guide through this.
Yeah, great question. So the program has been around since 1961. People use it three ways primarily: eliminate monthly mortgage payment, principal and interest monthly mortgage payment; access equity for people who have a lot of equity or have their house free and clear; or fund a purchase of a new home. So some of the misconceptions are, I give up title to my home. That's not true. It's just like any other mortgage. You're the title holder, you have a lien against your property. The differences are these two things. One, there's no payment required. Somebody can make a payment if they choose to, but a payment is not required. Two, these loans are non-recourse loans. For most people, they're used to personally signing for the loan. They're personally liable for the loan. If they go into default, the lender calls and says, hey, where's the money? What's going on? They start foreclosure, etc. With a reverse mortgage, it's a non-recourse loan. That means the only recourse the lender has is against the property, the sale or refinance of the property when the last borrower moves out.
Okay. So explain to me how it might work. Let's go through a case study. I've got a property in Eastside Costa Mesa in California. I'm at a position where is it a common misperception that only people of a certain age get reverse mortgages? Is that a common misperception?
So California is the number one state for reverse mortgages because of the cost of living there. I'm from Orange County, by the way. I grew up close to where you have your business. Yeah. But the bottom line is affordability is an issue, especially as you get older, because your income decreases. Maybe you're on a fixed income. Maybe you're concerned about outliving your resources. If we can take the mortgage payment out of somebody's budget, that frees up that money and they can enjoy those golden years. But yeah, the bottom line is a reverse mortgage is designed to do several things. One, allow somebody to remain in their home, retain ownership on title, gain access to their equity, maintain their independence, refrain from having a monthly mortgage payment, and basically enjoy these years of their life. We all work so hard. We get to that point in life. For a reverse mortgage, it can start as early as 55 for a jumbo reverse mortgage or proprietary. But most mortgages are HECM backed, home equity conversion mortgage, FHA backed. Those start at 62. But in California, we mostly do the proprietary because the values are higher.
Right, understood. So let's say that I'd like to I'd like to just understand, how does the bank get paid? Like in the sense that I've got a property, East Side Costa Mesa. I'm 50. What's the age bracket again? Sorry.
55.
55. Okay. I'm thinking about moving out of state, or I want to stay in my home and I want my mortgage to be paid off. I've got a decent size amount of equity. What are the requirements? And then what are the requirements in order to qualify? And then what are the requirements then once I choose to sell that asset, once I pass away, whatever those are, what happens at that point? Like, because obviously the bank isn't just doing it out of the goodness of their heart. What typically is the upside for them?
Yeah. So for the jumbo, 55 and over, both parties need to be 55 and over. For the HECM, the FHA backed, one party needs to be 62 or older.
Got it.
They can be single family homes, townhomes, condominiums, 2 to 4 unit complexes, as long as one of the units is a primary residence.
Got it.
The responsibilities of the borrower are to live in their home as the primary home, maintain it, pay the property taxes if there's an HOA, pay all that on time. As long as they do those things, they can't outlive it because the term of the loan is 150 years.
Oh, okay.
So you can't outlive it. So that's the age ranges, who qualifies. Most people, believe it or not, qualify with just their retirement income because they only have to prove they have enough income to maintain the home, pay the charges on the property, taxes, insurance, HOA, because there's no payment required.
Right.
Somebody can make a payment if they choose to, and we can get into that, what that looks like if they did. They actually benefit from that if they do, but they don't have to. What happens at the end? So think about it this way, Ben. Somebody gets a reverse mortgage, we'll just say at 55, and they don't make a payment. So it's a deferred interest loan. So that interest is growing month over month. So this is how the lender makes money. They don't necessarily make the money up front. It's a long-term play. Over time, that interest is accruing at whatever the rate is. For HECM, the interest rates are actually lower than 30-year conventional. With proprietary, they're probably today in 2025, this is July of 2025, 8.99 fixed rate. Adjustable is a little bit higher than that. The difference between fixed and adjustable, with fixed rate, it's a closed-end loan. If there's any money available, they take it all at closing. With adjustable, it's open-ended. Money's available throughout the life of the loan as long as there's equity available. And you mentioned a line of credit. These can come with a line of credit. It's on the jumbo, it's for 10 years. With the HECM, it's like I said, as long as there's equity available and they've met the criteria.
What's the typical criteria from a debt to loan ratio? So I got getting an understanding of what that looks like.
So it's based on three things: the age of the youngest borrower, the interest rate, and the value of the home. So let's take a $1 million home because that's probably pretty typical in Southern California, right?
Sure.
So if they're, we'll say 65, they can borrow about 50% of that equity at a fixed rate, 8.99. They take all the money at closing. So let's say they owe 400, they can borrow 500, they have 100,000 cash, no payment required. But let's take another scenario. What if they own their house outright? $1 million house. People who've done that have done pretty well, and they've probably used leverage to get to that point in their life, right? They haven't just fallen off the turnip truck, so to speak. I mean, they've been very intentional and successful to get to that point.
Of course.
Okay, so now they have $1 million sitting there earning nothing, earning 0% return. We can take 50% of that, and they can put that money to work for them, either with their financial planner or I've written a book
to get some type of income stream coming in, because
Correct.
A lot of people would think, well, why would I take the money out if ultimately interest is accruing on it? The reality is it's actually, you could put it in the market or a high dividend yielding stock or whatever it is, or an investment that is actually cash flowing them for a lifestyle perspective.
Yeah, the only restriction is they cannot purchase an annuity. That's the only thing they can't do, because in effect they're annuitizing their equity already.
Right, understood. Understood.
But the
So
big,
that's the only restriction on what I can do with the money?
yes, sir.
Okay. Right.
Now, where your audience may benefit is the third way, which is financing a home. So, there's people as they get up in years, they've lived in their same home for 20, 30, 40 years, whatever, and they don't want to move, but maybe they can't, maybe they're not comfortable with their current location. The neighborhood's changed, or perhaps they want to live closer to family, or maybe that home doesn't suit them anymore.
Right.
So I live in Colorado, so we have multi level buildings in Colorado, homes in Colorado. Somebody may can't do the stairs anymore, right? That's pretty common. So they
Sure.
have to find a ranch style home where there's no stairs, or maybe it's more senior friendly. The hallways are wider, et cetera, et cetera. So here's where it could benefit your audience. A senior could put up to 65% down payment, one time down payment, not have a monthly mortgage payment, and still have money left over to live on because they're not using all their cash.
Interesting. Interesting. So if I think about this from the perspective of, I guess, I'm trying to think about it from the perspective of, let's say that I do this and I come into some money, or I do it for a short period of time and I liquidate something else from a retirement perspective. And then I want to get rid of the reverse mortgage. Let's say I do it for 12 months, 2 years, 5 years, whatever it is. Can you pay it off any time? Is there any penalties?
No prepayment penalty. You can pay it off anytime. When we meet with people, we like to ask them how long they're planning to stay in the home. We like to see people live there at least 18 months, maybe even 2 years to recoup the cost of the loan.
Sure.
I mean, we're trying to benefit them. We're trying to help them do better, be better in that stage of life, not hurt them in any way. But yeah, we prefer 18 months, but there's no prepayment penalty. They can pay it off anytime. Quick story. I have a good friend who got a reverse mortgage with me. And I lead a weekly men's group, and he came to the group, and he's all excited. He goes, "I just sold a piece of property. I'm going to pay off my reverse mortgage." And it was the HECM, not the proprietary. Yep. And I said, "Mike, that's awesome. Congratulations." I said, "But if I were you, I wouldn't do that." He goes, "Why not?" I said, "Well, your loan has a line of credit, and that thing's growing at 7% a year, guaranteed compound interest, insured, protected from the market." I said, "Why don't you pay it down to like $100, and you got this gigantic line of credit that's going to grow year over year by compound interest. And now 10 years from now, your money's going to double." So almost every time I see him now, he reminds me how much money he has in his line of credit because he didn't pay it off.
That's pretty good. So the line of credit comes in as a percentage. How does it grow from that perspective? Because definitely my line of credit doesn't grow unless I draw on it.
Yeah, here's the differences between a HELOC and a reverse mortgage line of credit. HELOC, a payment's required. With a HELOC, it has a 10-year draw and a 20-year repayment. A HELOC, the interest is usually higher than with a reverse mortgage line of credit.
Yep.
And like you just said, your money doesn't grow, your equity doesn't grow. With a reverse mortgage, it can grow. So it's 0.5% higher than the interest rate. So let's say the interest charged is 6.5%. The interest earned on the line of credit is 7%. So I always tell people it's like a seesaw. You remember on the playground, the seesaw?
Yep.
You want interest working for you. So for these people who are have a lot of equity in their home, it's earning 0. They can now take a portion of that. We'll just say in this case 40%. $500,000 house. Now they can take 200,000, and it's going to grow month over month. So in 10 years, that 200, if they don't draw any money, that 200 now becomes 400, and then they can convert that money into lump sum cash or monthly payments. Wow. So a lot of people don't have long-term care insurance. Sadly, about 12% of Americans have it. This is a way to self-fund that, right? You're kind of preparing, like at some point, I may need to bring somebody in to help me bathe or dress or do chores or clean or cook or whatever. So you're kind of planning for that. You're not buying long-term care, although you could, but you're self-funding it through your line of credit.
So tell me about situations, like if you've had situations over the last, 12 months where you've had to say, no, you guys can't get a reverse mortgage. Like, what do those situations look like?
I actually had a guy that was ready to close. He was a retired pastor in Texas. The next day he was ready to close his loan. And we're calling him saying, hey, we got the notary coming out. Are you ready to go? And he didn't call back. So we had to push the closing. And then he called me a few days later, goes, hey, I just wanted you to know I fell and slipped and I got a concussion. Oh, I'm so sorry, Al. And he goes, in fact, it's causing me to rethink if I should do this because my kids now want me to move closer to them. And that's very common, where as you get older, you want to be closer to your kids. So we ended up not closing. That was one instance. I've actually advised people that maybe they shouldn't do it if
Okay.
they're terminally ill or they're going to move in the next 18 months or maybe this hasn't directly happened to me, but I've heard about it. You have a family member pressuring you because they want the
Right.
money. They want
Yeah.
access to that money. Seniors, sadly, Ben, seniors are the most vulnerable population. They really
Oh,
are.
no doubt.
And this
No
loan
doubt.
has so many safeguards and protections for seniors. I'm actually amazed at how well it's been put together because it really is very well thought through and has a lot of safeguards to help seniors not make a bad choice.
So as far as it goes when it comes to, the conventional loan market, right, is that you go and you get a conventional loan through one of the brokers or whatever it is that then put up the money in order to do it. Then they sell it to Fannie or Freddie, okay, and I guess they get them put into the, the big, the credit defaults or whatever they're called, the
Mortgage-backed
thing that,
securities, yeah.
yeah, this mortgage-backed securities, there you go, is that where do these go? Who buys them?
Yeah. Ginnie Mae is an issuer of the paper, and they back these. They're also overseen by HUD, and FHA is on the HECM side. About 90% of the loans are FHA. But then you've got private companies, there's a handful of them, that have the proprietary reverse mortgage, usually $1 million and up to $10 million. And you can borrow between 35 to 50%, depending upon age. Um, but yeah, the underwriting procedure is very similar. It's actually a manual underwrite. We collect about 6 things: photo ID, bank statements. Usually people don't have pay stubs, but they have a social security statement or a pension statement, 1099 from that, or an investment statement, homeowners deck pages. If they still have a mortgage, the mortgage statement. If they have an HOA statement, the HOA. That's pretty much all we need for underwriting. I tell people, I said it takes you about an hour to get the paperwork, an hour to do the counseling, an hour to do the closing, and maybe 15 or 20 minutes to meet with me to understand it, to see if this is a good option. So you got maybe 4 hours in to learn about it. And I always push resources to people so they can learn. I have a YouTube channel and a website and a consumer guide.
We'll make sure we link everything below for you. We've got all the links that you've provided us already to make sure that people can see that, because it is I got to learn a fair bit about it prior to actually jumping on with you so that I could speak relatively well about it, because I was just really unfamiliar with it. But the thing that I'm thinking about at the moment as you're going through all of this, it's like it's a scenario of that. How many people are going through their retirement not knowing that this is an option? That's one of the things. Now, how long does closing happen? So let's say I get everything through, I get approved, I get underwritten. How is it, like normal 30 days? Like what's the?
Good question. The industry average is 45 days from application to closing. I'm pretty efficient, my team and I, so ours is 21 days from application to closing, just because we do all the work up front. We like to get everything up front. If there's any issues, we like to resolve them before we go to underwriting. We get the appraisal order right away. And then once somebody gets that approval, they just kind of breathe a sigh of relief, like, oh, this is really going to happen. This is going to work for me. So.
Very good. Well, outside of that, Kevin, I think that's given us a very good overview for a resource that I didn't know a lot about. I'd heard about it, but ultimately had never dived into it. And I think that it could be a very useful asset or useful option for a great deal of people out there that are going through trying to figure out, do I have to sell my primary asset in order to actually be able to retire? I think that a lot of people would probably stay where they are if they knew about it. So all in all, thank you for the work that you're doing. And we'll make sure that all your links are below in the comments so that people can absolutely find you. But thanks so much for being part of Rethink Real Estate.
Thanks, Ben. It's been my pleasure.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.